a seasoned professional with a wealth of experience in the field of accounting, business analysis, financial planning and analysis, and business partnering and business transformation, change management, data quality management and governance, resource planning and project reporting, and budget tracking, which covers both industry practice and consulting. He is a chartered accountant of over a decade and also has an MBA in corporate finance. Over the last 7 years, he has continued to apply his project management and finance transformation expertise while leading multiple transformation projects worth over $100 million with the application of various project management methodologies. He has he has a proven record of success leading all phases of business improvement and transformational projects and collaboration with IT on diverse technology projects. He is a passionate evangelist of the United Nations SDG 4, with finance and accounting professional being his main participation, which explains the concept of the finance business partners. His core values are teamwork, leadership, and excellence. Talking about excellence, let us put our virtual ends together as we welcome Mr. George Jinadu. Thank you very much, sir.
Okay, thank you, Faith, for that wonderful introduction. Thank you for having me today. Hope everybody's day has been good and things are going very well. Okay, not to delay too much, I think we're probably just gonna dive into the conversation for today. So, it's a very interesting conversation for me. Why? Because I jumped into it with someone very recently, and it triggered something in me. We were just having a conversation about, okay, different types of businesses, different opportunities, that how do you measure the performance of a business? So a backstory to it is that someone had his one of his finance staff prepare financial statements and give him some KPIs in terms of, okay, this is a P&L balance sheet there. Put some ratios and numbers in there, and he was like, it seems this guy doesn't understand what he wanted and all that. So pretty much what was in there was just the generic, KPIs, or you put your OPEX to turnover, very fancy things that they teach all of us in school. And we now got deep into the conversation to understand that, look, there's a huge gap in terms of knowledge when it comes to KPI setting for businesses, because what we typically do, and I'm guilty to, every one of us is guilty of the same thing. When they say go and do a financial report, in the process of trying to impress your manager, you go online and Google which ratios can you apply, which day. So you just current asset ratio, profitability ratio, those kind of beautiful things, but not understanding that there's a step and there's a flow to the concept of KPI setting for every organization. So today's journey is just to give us sort of an introductory approach to it, because it's a huge concept on its own. As a matter of fact, I think you can run a BSc degree on KPI setting alone, but a lot of people don't know how deep that is. So today we'll just go into it, and we'll be talking about five key. We're having running through five key phases of this conversation today, and the first part will be what are KPIs. We're just going to try and come up with a simplified definition of KPIs to see why, how to even talk about it, or how to go about it. Then we'll talk briefly about different types of KPIs. There are tons of them out there, but we'll just touch a few that most likely will affect your day-to-day as a finance professional. We'll look at the factors that determine choice of KPIs, like how do you even choose what KPIs apply to your organization, to even your life. A lot of people don't even know that you can set KPIs for your own life, interestingly enough. Then pretty much question and answers. So as we dive into it, the first question I always ask is, or which we can ask is, what are KPIs? In simple English, KPIs are metrics that provide a clear picture of a company's performance. They are vital for decision making, strategy, and assessing progress towards goals. The key elements here for us to take in, is about one, company's performance. Then 2, decision making. 3, strategy. Then 4, goals. So what do I mean? In essence, before you can talk of a KPI, you need to first define a goal. It's not just enough to run the P&L and put, oh, okay, we grew by 5% sales last month. Our expenses grew and all that. Before you can determine a KPI for those numbers, you need to actually have a goal, and it's important that that's where it starts from. So in trying to get that understanding across, I decided to decompose the whole word of called KPI. And the first one is the K in the key. What is key? A key in this context means crucial factor in achieving an objective, meaning that it is very important. It's a factor that is so crucial to achieve your overall objective. You can't achieve that objective without that factor. So when you're looking at a KPI, if you look at the P&L of your organization, it's not sufficient to say, okay, we grew sales. Is that the objective? That's one. If it's not the objective, or even if it is the objective, that particular metrics being measured, is it crucial to achieving the objective of the organization? So for example, most organizations will come up, oh, this year want to grow sales by 20% year on year. Good. So what are you measuring? Is it crucial to that or not? If you're just measuring, leverage ratio, the company is highly in debt, our debt increased. So what? If we have all agreed that our goal for this year is to grow sales by 20%, your thought process should be around, what are the things that we need to measure around sales? So it's not sufficient for you to say, sales grew. In there, you might start thinking of things like, did we have the same number of customers last month versus this month? Is there an increase in that? Did we have the same pricing last month versus this month? Is it a margin thing? Whatever it is, you need to start thinking what is crucial to achieving the goals of the organization. From there, it helps you determine what is key in the keyword KPI. The second one is P for performance. Performance means how do you execute? How do you deliver? You are measuring are we hitting the numbers we set? Are we doing very well? That's what performance means in simple terms. Like, are we performing? Are we, making progress? Are we achieving what we're supposed to achieve? And lastly, before you can determine if you're actually achieving what you're supposed to achieve, you need to get to the I in the KPIs, which is basis of measurement. You can't just measure what you did not set a criteria for. So like I just gave you my example, want to grow sales by 20%, meaning that if our current sales for our last year sales is 100K, this year, 20% of 100K is 120K. So you have to set a basis. Like, it's not sufficient to just say, just measure anything. We grew by 5%. No. The question is, we are supposed to grow by 20% on a certain number. So how do we measure our performance? We take that certain number and we take the 20% of it, which becomes our baseline measurement. Then we start to measure along that side. Okay, are we hitting these numbers? Are we executing towards this? It may not necessarily even be financial information per se. It could be other things, non-financial KPIs. But ultimately, there has to be these three key elements to make a KPI make sense. There has to be a basis for measuring what you want to achieve. There has to be the execution itself. Are you doing it, while you measure it? Then there has to be, whatever you said, has to be critical to to achieving that objective that you set for yourself. So the next slide comes to different types of KPIs. So for every organization, for every business, for every department, for every individual, we have multiple types of KPIs. For example, on an individual level, you can say that this year I want to save 100K. Whatever your basis, whatever you need to do to set that as a number for yourself, you can determine it. It's all on you. But the most important part is you set your target, which is my KPI this year, is to say that, okay, at the end of the year, for me to say, okay, I have performed successfully well, I would have saved 100,000 naira. If I don't save 100,000 naira, I look at what percentage of it I'm able to save at the end of the year, or if I break it down to month on month, say, okay, I'll divide that 100,000 by 12 months. This is what I should be saving on a monthly basis. I can measure that performance, say, oh, okay, am I meeting my target? Am I far off? Do I need to improve my performance and all that? So in here, we'll talk just about a few KPIs, the critical one every organization looks into. First one is financial KPIs. We all know this. Every organization has some form of financial KPIs that they measure. They measure the revenue, they measure profit margin, they measure cash flow, you measure assets, you measure expenses, you measure that. There are like 1,001 of them that you can define for your organization. And every organization is very key. No matter how big or small you are, or whatever industry you are, you still need to measure some of these things that relate to financial KPIs. The next type of KPIs that many organizations or many people even measure is the operational KPIs, which is efficiency and productivity. You look at things like cycle time. You look at things like lead time. You look at things like inventory turnover for organizations that are into sales. You look at things like, for example, people in the banking industry understand that, I think it was last year or 2 years or 3 years ago, I can't remember the exact time now, that CBN made a rule that all failed transactions should be reversed within 24 hours. So that's an operational KPI. It's got nothing to do with money, but it's operational. Are we meeting that as a target to make sure that if your transaction fails, you get an automatic reversal within 24 hours? Therefore, people in procurement, you understand things like lead and lead time between when you order for something and when the thing gets to your warehouse or gets to you. Then cycle time, how long does it take to start and end the process? So operational KPIs measure efficiency. You try to see that, okay, am I running what I'm doing efficiently, or is there a better way to improve the time of even you submitting your financial reports? Maybe you have a 7-day after month end window to submit financial reports. Those are operational efficiencies. Are you meeting up with those 7 days? Are you building structures around it? Another type of KPIs that we look at commonly in most organizations is customer KPIs, which pretty much measures your customer service efficiency. For example, you have your Net Promoter Score, NPS. Net Promoter Score is pretty much to say, okay, at the end of the day, if some of you use Access Bank or some other banks, when you complete a transaction, it asks you to rate that performance, or even when you call customer service in most organizations, it asks you to rate performance. So that's essentially what your Net Promoter Score measures, to say, okay, hey, I served about 10 people today and 9 of them were happy with our performance. So that's a 90% success rate in terms of that KPI. Or I served 10 and only 4 were happy, 3 were in between. So you try to measure those on a month-by-month basis. Organizations which commonly measure NPS, not Net Promoter Score, pretty much focuses on, it's sort of tied to efficiency too. You want to see, or effectiveness rather. You want to see if, are we improving in terms of customer service? Because if customers or customer service is key to revenue for your business or to growth to your organization, you have to measure how the customers are feeling. And, sometimes I'm sure some of us have had some of the worst experience with some banks. And, and that was one of the reasons that I even got organizations like digital banks to even have an opportunity in the market. Then you have marketing KPIs, customer acquisition cost. How much does it cost to bring in a new customer? Cost per lead, website traffic, like for blogs. They measure things like how much traffic comes to their website on a monthly basis. Then if you look at the chart on the screen, you have some other perspective that you can also use to look at KPIs. You can look at them from qualitative. Is it what's the quality of the KPIs, or quantitative? What's the numerical value? Like, okay, are we making more money or less money? Qualitative pretty much is things around, okay, a Net Promoter Score is not necessarily money related, but it also helps you measure efficiency to, okay, things that simple as even customer defects. That, okay, how many of our products that we produce do customers return? There are thousands and thousands of KPIs that you can measure for your organization. Yeah, just like I said at the bottom there. Then the next will be, what are the key factors that determine choice of KPIs? And I think this is one place that we need to look at very, very critical, because for me, this is the crux of the whole conversation. Because you can have two organizations with similar type business in the same industry, but they measure things differently. So I'll give you a typical scenario. For a startup in the financial services industry, let's say a bank, let's use a digital bank, which is, there are a lot of them now. There's Kuda, there's Alerts, there's Sparkle, there's Carbon. There's a couple of them out there now that are into digital banking. We all know that they play in the same banking industry. But guess what? They measure different KPIs. While a GTB or a Zenith or an Access is measuring a different set of KPIs, meaning, they are looking at total interest earning transactions, interest on bank loans. They are measuring things like, non-performing loans. For people who are in that industry, if you've seen the financial statement of a bank, you realize that, banks make money from interest on loans when they charge companies loans, and they take deposits also to be able to borrow people out. So their cost of funds, which is interest expense to them, is customer deposits and the interest they pay you. So they make money off what you call an arbitrage, which is the difference between what they pay you for borrowing, for keeping your money, against what they earn for borrowing out your money to someone else. That's how banks make money. So a lot of banks focus on that, interest expense, the customer deposits or balance sheet size, because what balance sheet size effectively means is that if I have 1 billion naira available to me, and the CBN has a rule that there's a 60%. I don't know if I can't remember if it's still the same. For people in the industry, you can correct me if I'm wrong. 60% loan to deposit ratio, meaning that for every deposit you have, for every 100 naira deposit or 100,000 naira deposits of customers that you have, you must borrow out 60% of that. So at least you must make sure that 60 people, you have equivalent loans that you borrow people out to the tune of 60% of that 100,000, which is about 60,000. So those are some of the KPIs that they measure as GTB and Co. But guess what? A bank, a digital bank in a startup phase, they measure those things, but not so critical to them. It's not so crucial. Their focus is more around, and that's why if anybody have seen some of these startups, fintech guys in LinkedIn, sometimes they post their stories. They will tell you around total value of transaction that happened on their platform, and you'll be wondering like, maybe last time I think Kuda or Flutterwave or it's not, Flutterwave is not a bank, but it's still the same in the family. They'll tell you, we processed $1 billion worth of transactions last month. And you'll be wondering like, dude, for people who understand the way these things work behind the scene, $1 billion transaction doesn't mean they made $1 billion. Because guess what? For especially payment companies, they make money per transaction, not per value, not as a percentage of transaction. What do I mean? If you have ever done transaction through any maybe InterSwitch or whatever, you'll see that they'll charge you a fee and they'll say it is capped to 2,000 naira. So if I decide to wire $100 billion today, they can't charge me more than 2,000 naira for that transaction. So even though a company is making noise about, we processed $1 trillion on our platform, in reality, they might not have made more than 2,000 naira, because if it's one customer, the max you make is 2,000 naira. And you start to wonder like, so for sake of argument, you're coming from the background of a traditional bank, a GTB Access. You join one of these startup banks, digital banks, and you start to bring your mentality of the traditional bank. We need to measure loan to deposit ratio. We need to measure interest expense over interest income. We need to measure all that. And they are looking at you and laughing that, no, we don't measure that here. What we focus on here is total value of transaction that has happened on our platform, number of customers doing transactions on our platform in that particular month. and you start to get confused. The reason is very simple. You first need to understand what is the business model, what is the company vision. And the reason is this: a startup is still in the fundraise mode. They are permanently raising money to continue because they are not profitable yet. And the only way you can make money raise money easily as a startup is when you're able to show growth, when you're able to show trust to your investor. So at that point, they are not interested in profitability. When probably some of you measure EBITDA or net profit. A startup is at a loss position consistently, is burning cash. So they are not interested in net profit numbers. You come in there and tell them, look, we burned more cash last month. So what? They don't care. At that point, they focus, one, how many new customers did we get? What is the average value of transaction per customers? What is the total transaction processed on a platform last month? Because those KPIs measure trust. And that's what investors want to see. Investors want to see growth. That, what is the trust factor of your business in the market? Are people bringing in money to do business on your platform? That's why what you see. How many of you have even wondered why most digital banks, especially Kuda, will tell you free transaction? Do you really think it's free? There's nothing free under the sun. Let's be very honest with ourselves. And let me be very clear with that. I can tell you from someone who has been in the industry. There's nothing free in the market. For every single transaction you do for interbank through maybe all these digital banks, they pay, the last time I checked, I don't know if it's still the same amount, they pay 5 naira per transaction. So for every free transaction you're getting from those guys, they're paying 5 naira on your behalf to whoever it is that the money is going into, which is most likely NIBS, Nigerian Interbank Settlement Scheme. The whole idea for them is that they are treating it as marketing cost to acquire you to come and build trust and do transaction. So a GTB will never give you free transaction because they are beyond that stage. Their business model is beyond that. Their company vision is different. They are at a different stage. So they don't need those type of KPIs anymore in terms of getting new customers. As a matter of fact, they don't care. If you like, come and go, it's your problem. Other people will come. They have built trust and they are fine. They even do better with or without you. So I'm not saying that literally, but logically, that's the truth. They are big. There's nothing you can do about them. So first of all, you need to understand what the business model is. You need to understand the company vision, which means you need to probably get engaged with the key decision makers and say, this is a thought process. Therefore, I can build KPIs that would be able to measure and help support those thought processes. The second one is maturity stage, which I've already mentioned in the first item that I mentioned there. It precedes, for example, like I said, the KPIs is customer acquisition. That's the goal. I don't care if you're making profit. Some of you maybe you might not have known back then, but I was in the industry then too. That was 2000 when Konga and Jumia wars was happening, when you hear free delivery across the country. Some of you, I'm sure they still do it occasionally. You hear free delivery. Guess what? Nothing is free. Nothing is free. They pay for those delivery costs. In fact, as a matter of fact, I've seen transactions back then where somebody would be in Maiduguri and order something that's in Lagos, maybe something of 100 naira or 1,000 naira, because it's free delivery. To ship an item to Maiduguri 2014 will cost you about 3,000 naira back then. And this is a product that you're selling for 1,000 naira, even less. In there, your profit is not more than maybe 10%, 100 naira. So you effectively use 2,900 naira to dash away to somebody. A bigger company who is in an IPO stage will not do that because they've built their trust. They are at the level that those kind of things they can't afford to do it. But an early stage business, pre-seed, seed, or growth will do it because what they're focused on is customer experience. They want you to try the product out. There's what you call customer lifetime value, whereby they do an assessment that, if I bring this customer on board, in e-commerce it used to be 2 years. Over the next 2 years, this person is going to purchase from me. How much is this person going to spend on my platform within that 2 years? And from some estimates, you can get as high as each customer will spend an average of 10,000 or 20,000 before they stop buying from me. If they spend 20,000 naira, for example, and I make a profit of 50% of 20,000 naira, which is about 10,000 naira profit, I won't mind spending 3,000 naira to bring the customer on board, because I know for a fact that the customer is going to purchase items on my platform for the next 2 years, and is going to end up spending 20k for sake of argument, and I'm going to make 10k. So it's a KPI of cost of 3k as against a 10k profit, which gives me a 7,000 naira net profit. So these are some of the KPIs organizations measure at those stages. So a big company, like I said, in IPO exit will not do that, because you have shareholders who will scrutinize you and come to board meetings that, why are you doing this? Versus a startup company whereby it's probably a CEO and family and friends. So they take those kind of decisions faster, and they can measure those kind of things. And is it making the right impact? Is it? Then I remember when I was at Deal Day, we used to do what we call cohort analysis for every customer. So we do a campaign. Then there's a campaign that your wallet will be credited with 1,000 naira, but to activate it, you need to add additional 1,000 to buy something. So you, of course, now you want to activate it. You bring you 1,000, you buy stuff. Yes, it's a direct loss at that moment. But what we do is, for that campaign, we measure the number of people who sign up. If it's 1,000 people, then we observe them over the next 1 year. So it's called a cohort, to say, okay, hey, all these customers are acquired through this campaign, month on month, what is the average spend? Definitely not all of them will continue buying. Then there's the early adopters who will continue to buy immediately, and there are some who will take 3 or 4 months after before they buy. So you measure that particular cohort over a year to say, okay, hey, we spent 1 million naira to acquire this number of customers, and over the past 12 months, we've generated a revenue of 15 million with a profit of 4 million. Definitely not all of them will contribute to that revenue and profit, but as a marketing campaign, it becomes a success for us, because we probably would have set a benchmark that, okay, we want to get a 4x, what you call a 4x return on investment. So if you invest 1 million, we want to be able to use that to generate a net profit of 4 million. So as long as 1 year we are measuring that, okay, these guys within this bracket has helped us to achieve that, it's a success. Now, what I've just mentioned is a KPI that you probably will not see on the face of your regular financial statement, but you will get if you interact with senior management or people who take decisions, because you understand what the company is trying to achieve. This was one of the KPIs we built. We called it a cohort analysis. It's something that marketing department uses more, but as a finance person, then I was still working around FP&A. You need to understand those numbers too, because they impact the marketing people will not be able to pull out the profits level type things from you. You are the one that provide that information, but it's in the process of interacting with them that you'll be able to successfully provide that kind of information. So you need to understand what this maturity stage or the stage of the business to, and very importantly, engage the business owner, and that way you'll be able to help determine what KPIs to measure. Then the next one, the industry. Every industry has its specific KPIs, and as individuals, you also need to have, there are regular KPIs per industry, and there are some that you will tailor to suit your organization. For example, what a bank measures is different from what a fintech company measures. What a marketing company measures is different from what a SaaS company measures. So a typical scenario, I can tell you that for companies who do B2B, business to business, and do phone call sales, there's a particular industry, I'm trying to remember, it's trainings, yes. For organizations who provide trainings to other organizations, that, okay, you train the staff of a company, it takes an average of 10 to 12 phone calls for you to close a transaction. So from the point of initiation of sending an email to the company, to following up, to speaking to who they call the gatekeeper, maybe it's one manager that doesn't like a business, to being able to access the CEO, you have at least 10 to 12 touch points with that organization before they eventually say, okay, dude, come on board, come and train our staff. Those are some fundamental KPIs in certain industries that are like that you see. So you can now benchmark yourself to say, okay, hey, I know I'm going to do 12 calls to achieve this. How do I reduce it to 10 calls? With that, you can now even say, okay, for our B2B business to business team, how many calls are they making per week, to close a client, you can now set something along that line. Remember, the keyword there is crucial. Like, you're trying to set something that will help you achieve a crucial objective, or is it crucial to the goal of the company? So you need to understand some of the key elements of those KPIs. Like, okay, hey, for a salesperson to be successful, it is an industry standard that you must make 10 to 12 calls or 10 to 12 touch points. Then you start to measure, okay, hey, are we even making those calls? So it's not a case of, okay, someone will try to reach out to company 2 or 3 times and they'll say no, and you close out the deal that, okay, no, we've given up. So you start to measure, okay, hey, you said you have 10 items in your pipeline last week. You said 4 said no. Do you now close the conversation, or do you continue, start to measure, okay, how many conversations you have with them and things like that. So it's very, very important. And guess what? For me, the most interesting part of this one is government. A lot of people don't know governments also have KPIs. They have KPIs to the people. Like, we can see, the easiest way to define KPIs for government is from their campaign manifesto before they even come and say, okay, hey, this is what we're going to do. And that's why people who follow politics or who understand it will say, commit politicians to issue a documented manifesto, not through their proxy, not through their spokesperson. Let them bring out a document, 5-point agenda, 7-point agenda, which is what today, even when you talk of when the former president, Buhari, people will say he did well, some people will say he didn't do well. It's on those things that if you want to really measure, there's a KPI to say, okay, hey, what did you say you will do well? Security, economy, corruption. That's a KPI for him, which you can measure to say, okay, did he do well on this basis or not? How did you define it? What are the critical things to say, okay, whether it did well or not? So every industry, every organization has its own, unique type of KPIs. Then industry compliance factors. So this is also very key. These are regulatory KPIs that you must measure. So for example, I know, maybe not in Nigeria, but Europe, there's GDPR. I think Nigeria too has NDPR, data protection, whatever, something around data protection that you need to measure. Then even things like, we even have a lot in Nigeria, CAC filing, tax filing, FRS. You must do your monthly remittances. You need to start measuring your KPI. Are we meeting it, or are we missing those timelines? Are we getting penalized? Even internally, well, depending on even your industry, if you are like a public interest entity, you file things like SEC reports, NSE, stock exchange, and basically those kind of situations. So there are regulatory or compliance factors that also help you determine the kind of KPIs you measure, because that the implication of not filing some of those things can be a huge disaster when people come along to come and start checking your books. And nobody likes it when getting audited, and it's one of the most horrible experiences you can go through. Internal operations, very key. Every organization has and must set internal operation KPIs. How do you run day to day? Lateness, how do you determine lateness? Or you don't know that measuring when you come to work late is KPI measuring. It's part of KPI now. Your KPI is that some organization, you say you're allowed to be late no more than twice in a month. That's KPI. So they are measuring you are late every day. That's why some systems, they'll put you clock in, clock out. Then in terms of communication, is your department having a problem or not? How many of your people are you training? Those kind of things. Every organization will have those situations. There's what you call service level agreements within organizations through SLA, internal SLAs. That, okay, hey, if you have companies who, in fact, every company has similar problems. Even if it's financial services, you have SLA between department when the customer service will raise a ticket and issue it to the dev support or whatever they call themselves, and when it will be resolved, versus even finance when procurement or whoever it is will bring a bill or an invoice to finance to make a payment to the vendor. How long does it take for finance to pay it? So you have those KPIs too. Then even as staff, whatever you agree as your goals for the year is your KPI. For people working in organizations who set goals at the beginning of the year for staff, that, okay, hey, this is your goal. This is what is expected of you for you to be promoted to the next level. Those are some of the KPIs that also work internally. There are tons of them, depending on what you want to measure and what is critical to the success of you helping the organization achieve its goal. So this is a simple slide to guide you around what to consider when you want to set up a KPI. Sometimes it's more complex than this, but I try to simplify. I saw this and I think this sums up everything I want. The first thing is, before you can talk of a KPI, you need to define a target. What exactly are you trying to achieve with that? And I think that's the biggest problem I see every day. Everybody will just come up, oh, this one, that one. Somebody was telling me, I worked in an organization and somebody was bringing a report to me. Man, we are highly geared. We're looking at our ratio of loans to ratio of asset. Man, our loan like 95 or almost 100% of our asset. And I started laughing like, look, don't throw a useless, I'm sorry to use that word, but it was for me, like, don't throw a useless data at me and expect me to listen to you. First of all, have you ever sat down to understand the business model and the core of our company? So I had to take the person through the journey of the business model and the core of the company. And what do I mean? There are different ways you can finance your business. You can either finance your business through equity, which is selling shares. You can finance your business through debts, which is borrowings, or some of you may not know, accounts payable is actually debt. It's pretty much using other people's money to finance your business without giving them shares. So if you are very good, and that's something I've driven in the past a lot. Like, if you are very good with managing account payables, you permanently never need money to finance your business, because if you have a cash turnaround cycle that is shorter than your AP period, you are fine. If your AP is 30 days and you have a cash turnaround cycle of 15 days, you are in the best situation where you get the inventory and sell it in 15 days. You are permanently using someone else's money to trade. Then the combination of both, it could be mezzanine, it could be other instrument. So I explained it to the guy that, look, have you ever, looking at our balance sheet, so I had to, break it down to him as an accountant, looking at our balance sheet, what do you see in there? Looking at our CAC documents, how many shareholders do we have? We only have 2. Is it not a sign to let you know that this is a debt-driven business? Meaning that the business model or the core of the business is to use loans to finance transactions. So in running the person through that process, he now understood that, okay. I said, so you telling me that we are highly indebted, you're not telling me something that is helpful. If you ask me, it's a different conversation. That, hey, you notice that we have huge amount of debts in our books. Is there a reason for that? Bank loans. Then I'll be able to explain to you. So in that case, what you should be measuring, which is what I told him, and I sent it back, and he did a very wonderful job, to be honest. Kudos to you today. I don't want to mention your name, but I'm sure if you are listening, you know who you are. He did a wonderful job to analyze the interests on the different bank loans, to be able to now come back to measure that, hey, boss, this bank seems to give us a better interest versus this bank. Whereas the one that gives us a poorer interest will have more exposure to them. Shouldn't it be better if we move our debts to the bank who give us better interest, or to renegotiate with the other one? And we're able to go through that process, and we renegotiated and we got a better deal. So in that scenario, the guy came up with KPIs, which banks will give us the best interest, which will save us money. And he started tracking and he shared the information, and we took it to the CEO and it was approved, and we were able to move around, renegotiated what we could renegotiate, move around some of the exposure back, and we got a huge savings in terms of interest expense every month. Now that's an approach to determine the right KPI to set. So not just go into Google and say, what do I use to measure the KPI of a bank or a company in retail or an e-commerce company? It's not sufficient. You have to be very specific. What goals are you trying to achieve? Are you trying to see if you can reduce costs in terms of expenses? Then you set KPIs in terms of maybe how they recruit or in terms of budgeting, Or are you trying to increase costs in terms of interest expense, which you pay on loans? Or are you trying to set KPIs to see how we can better finance our company, e.g. through accounts payables? Or are you trying to set KPIs around reducing receivables? Say, okay, hey, if the problem with receivables is that most of people who owe us take about 45 days to pay, can we incentivize them further that, okay, if you pay me in less than 30 days, you can get additional 1% off? You can set up those kind of incentives and see. So, but the bottom line is it has to be critical to the success of the goal of the organization. You define the target. That's the first step. Then the second step is it has to be measurable. Like you can't just set a KPI that's not measurable. Okay, we want to grow sales. So what? Or want to save costs. So what? You can't just be penny pinching up and down when somebody wants to, I've seen organizations where we are spending money on water dispenser. This is very funny. Water dispenser. Someone decided to save costs by saying we should reduce the amount of water dispenser bottles that we're buying in the office. I mean, yeah, it can be a KPI for the person. Say, hey, okay, we've reduced water dispenser from 20 bottles in your dispenser per week to 15 bottles to save cost, and all that. But at the end of the day, in my mind, looking back retrospectively, I laugh because every time I remember, I laugh a lot. Like, okay, so a KPI is reduce the amount of water people are drinking in the office, or reduce the amount of time they turn on the AC. This one that this is now like 1,000 naira per liter. So, but the bottom line there is that it has to be measurable. You have to be able to put a number to it. So even if it's a non-quantitative KPI, like things like net promoter score, you should also be able to apply a percentage that, okay, out of every 10 people that do this, 8 people say this, 5 people say that, and all that. So you have to be able to measure it. Then the third thing there is you have to define the data source, which is, for me, is very, very important. KPI tracking, you see a lot. And I think this is even very common if you work in any organization that is sales driven. I mean, no organization that isn't sales driven, but if you have an organization that the sales department is a standalone department, you have this a lot in terms of argument. Salespeople will always bring their numbers, which will never tally with the numbers of the finance department. I've never seen where those two match. I don't know, maybe one day to match. But it's very simple, and reason being that the basis for measurement is different. To a salesman, the salesman believes that if I close a deal, like I get someone to commit to buying 1 million naira worth of an item next month, I bring the contract in, I drop it. A salesman officially has sold. But to a finance person, under the prudence concept, you haven't sold nothing. All you have done is just brought a piece of paper that can be cancelled tomorrow. So the only time a finance person will recognize that KPI sale is when there's transfer of risk, where the item has been given to the customer. And most importantly for me, this is the biggest one, when the money is in the bank. If the money is not in the bank, you might as well have dashed away the product, because we've seen situations where you sell and it becomes a bad debt at the end of the day. So for you to be able to define and measure it properly, you need to define that data source. You need to agree that, okay, hey, this is your measurement, this is my measurement. However, for us to be able to be on the same page and make sense out of this, this is what will be our agreed data source. It will not be your document or your file that you keep. It will come from the ERP, the accounting system we use. And you will also have access to the sales module to see your own view of the reports, while I see my own finance view. So at any point in time, that accounting system will be a single source of truth. So even if you've called somebody, even if you sold on phone, as long as it's not documented, it's not done. I used to have situation where guys in my team argue with corporate sales team. Okay, it's my sale now because I ran it through this system, yada, yada, yada. But we all agree that if it's not documented here, it's not a sale. So we can't measure your performance based on that KPI to sell X amount of items, because we don't have any data to prove that the sale came from you. So you have to define that source. There are tons of sources you can have, but there has to be well defined. Okay, this is what we'll use to measure this information. And that's very key to it. Then the next one is reporting. there has to be a frequency to it, because KPI is not just measured once. Yes, you want to grow sales by 20% at the end of the year. You want to grow from 100,000 naira to 120K by the end of the year. You have to measure monthly, at least, at the minimum. It could be quarterly, it could be whatever it is, but there has to be key milestones that you track to be sure that you are in line with what you want to achieve in terms of the KPI you set for yourself. Because if you don't do that, you will just be wasting your time and making a useless exercise. You just find out at the end of the year that you didn't meet what you set for yourself as an objective or a key performance indicator. Therefore, you didn't perform well, and you're confused as to why that is. So for me, this very key elements is very important that we take into consideration when we are measuring our KPIs. So I will stop at that to say that one of the key things that we all need to understand is that KPIs are key to the crux of any organization. It's not just sufficient to go online and download any form of KPI that you think it makes sense to you. No, it's not. The first thing is you need to speak to the owners of the business. You need to understand how every business operates. I always tell people, try to be a finance business partner and not an accountant. The reason is very simple. Accountants focus on historical facts. They take numbers, they present it in standard reports and share. But finance business partner means it's a finance professional with business knowledge and is partnering with the organization, meaning that there's collective responsibility, not just sending out reports. And the easiest way to do that is by building the business side of you. It's not sufficient for you to sit in your corner in your silo in the office to just look at P&L every day. It's very important to set up meetings with the sales department, with the procurement department, and most importantly with management team. What is the CEO saying? What is the ED finance, ED sales? What are they saying? What are the goals of the organization? With that, you can develop yourself in terms of understanding, okay, this is the goal that we're trying to achieve as a company. Based on that, what are the key elements that I need to measure? Are we at this point an early stage business, a startup, whereby the focus is... So for example, let me give you a typical scenario of some of the experience. So some of you who have worked in e-commerce before, there's one data that you see that they measure. They measure what you call gross merchandise value, GMV. They measure what is called net merchandise value. Gross merchandise value means the total amount you spent on that transaction. So for example, I see a pair of shoes for 10,000 naira. I am paying 10,000 naira. You and I know, at least for people who in that industry, understand that what will eventually come to the customer, to the seller or the vendor, is less than 10,000 naira. Because the bank would have taken their fees, whatever fees needs to go, VAT, yada, 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 will be out of that transaction. So by the time you deduct that, whatever net is what comes to the seller while you process based on that. So at that point, what you have coming to the seller is the net amount, the net merchandise value. Merchandise means, the product. While the full transaction window, which is the 10K the customer brought out of his pocket, considering the fact that it might have gone through payments and everything is from there, is what you call the gross merchandise value. The same e-commerce model has what you call proprietary trade and agency. They call it different names in different organizations, but it's left for you to understand how your organization handles it. So, for example, in e-commerce, you have what you call a marketplace. A marketplace means that you bring buyers and sellers, right? And that's why if you see Jumia, some of them, they will show you the vendor that's selling it on Jumia, which means if Jumia is not the one selling that product, the only thing Jumia gets is when that product is sold, Jumia gets a percentage of the commission or a commission on that transaction. So if the transaction is 10,000 naira and Jumia's own is 10%, Jumia will get 1,000 naira from that 10,000 naira. So in reality, if as an accountant, what Jumia should track is the 1,000 naira in its revenue, because that's the real revenue for Jumia. Even though they facilitated the whole transaction, they powered the payment whereby the 10,000 was taken from the customer. But in reality, it's only 1,000 that is their own in that money. But when Jumia is running its report at the end of the month, I'm just using it, I'm not saying this is what Jumia does, but it's a typical e-commerce model. When they are running it at the end of the month, they'll take the full 10,000 naira as a GMV on their platform, because that's the value of transaction that happened, that occurred on that platform that is owned by them. So you'll be wondering, like, why are you measuring what is not yours? Is inside your own money, the only thing that concerns you is 1,000. But it also measures the strength and trust level for an e-commerce business. Say, okay, someone is comfortable enough to spend 10,000 naira on this platform. It shows some level of trust. And those are some of the numbers that investors also use, because some of you, like I mentioned earlier, you hear that, okay, free delivery. The whole idea of the free delivery is this: for every startup, there's a financial model, there's a financial forecast to say, okay, over the next 3 to 5 years, we're going to grow in this rate. They will take that number and plug it into a valuation model to say, okay, hey, based on this, your growth trajectory, that you get 1,000 new customers every month, and out of that 1,000 new customers, you have 600 customers buying consistently from you. Based on that, if we plug that information into a financial model, we will value your company at $5 million. So they are valuing the company not based on the net profits. They are valuing the company based on new customers coming in and spending money and doing transactions. So if you understand that, you won't spend your time focused on, our net loss last month is 50K. Hey, this month is 100K. We are in trouble. You're not going to be interested in measuring such KPI. It's nice. It's fancy. You put it there. But I can assure you, the owners of the business are not interested. At that point, the kind of things that the owners of business wants to see is that, okay, how many new customers came in? How many returning customers did you have? How many customers, what is average basket size? How much do average customers spend when they come to shop? If you measure those kind of KPIs to tell them that, okay, we are benchmarking on last 3 months, we are not going up or going down. As a finance person, which is separate from your P&L, you plug in those numbers in there. I used to plug it in most of my reports. Total value of transactions, total customers. In my total customers, I split it to new and returning customers. Then later I put supporting sheet to say, okay, customers that are bought that have bought within the last 3 months, I've been bought consistently 3 times, and customers, I create those buckets. Even though it's not my full KPI, it's for marketing, whatever they do, they have their own way they measure it. But as a finance person, it's a story that I'm also telling, because what you're doing with KPIs and tracking and measuring is you're also prompting the owners of the business that, hey, there is a trend here. There was one time I even did some analysis whereby, like, a geographical spread. So, okay, to say, and this is common for many companies in Nigeria, by the way, you want to see where your customers are coming from. You want to see in terms of value, and you want to see in terms of volume. The reason is this. I don't want to mention the name of the company. When I was CFO, one of the things we were trying to look at was we were competing with the bigger boys, the Jumias and Kongas. They had all the money in the world. These guys are raising 20, 50, $100 million so they can open locations in all the funny places of the country. We couldn't. So what we did was become creative. And our creativity was like, okay, look, month on month, we run the P&L, run who bought from us, where are they buying from? Then we started realizing there was a trend that there were certain people buying from, was it Benue State, a particular city in Benue State, and we started realizing it was growing, So for us, measuring that as a KPI, it's okay, what is our geographical spread? It helped us trigger the fact that, okay, maybe we might need to open a physical location in there to serve those customers better. But at the same time, you now need to this is a different part of KPI tracking entirely, to do like, should we rent an office or should we outsource? That's a decision entirely different. But that decision will not have come to light if someone wasn't measuring those kind of KPIs to say, okay, hey, if we want to increase our sales, and we're currently looking at the numbers, and to say 90% of our customers are in Lagos, and we are selling a product that should be useful to everybody across Nigeria, you can start to ask yourself, can we track geographical spread also? Like, is it possible to see how we can expand, to other parts of the country to see if there's some part of it that we're missing? So those are some of the KPIs you can introduce to your organization. But like I said, the first thing is you need to understand the business model. You need to understand what the owners of the business are trying to achieve. Because if you don't understand it, you're just going to measure anything that is not going to have any impact on whatever you want to do. So with that, thank you very much. Any questions, please?
Thank you very much, Mr. George, for that amazing session. I'll call it a learning session because I personally learned a lot. And I think at this point, I'll start calling myself a KPI expert because all the things I learned today. So now we'll be moving into the question and answer section. Please, if you have any question for Mr. George, please can you raise up your hand, like using this emoji? This is an emoji. If you have any question for Mr. George, and also while we are waiting for that, if you're not a member of the Finance Business Partners and you're interested in being a member, I dropped the links to our various social media platforms in the chat box. And if you're also interested in connecting with Mr. George, I also dropped the link to his LinkedIn profile as well, so you can connect with him and learn more. So yes, we have a question from Abubakar Olayiwola. Please, you can go ahead with your question. Abubakar Olayiwola, you are raising up your hand. Can you go on?
Yeah, hello, good evening.
Good evening.
Thank you so much for the wonderful lecture. Really appreciate it. Learned so much, sir. Please, my question is a bit funny, but the question is that who is responsible for computing or measuring KPI? Is it just any account person, or like, for example, now is it like, does it mean that an auditor can do it, or a senior accountant, or any account person can just decide to like compute the KPI for the organization? And like, does he have any specific position that one can attain before thinking of computing or measuring KPI for an organization?
Okay, that's a very good question. And for a very simple and straight answer, I would say there is no limit, there is no rule, there's nothing stopping anybody from computing KPI. So the very beautiful thing about KPIs are there's one big KPI for every organization which cascades down. So for example, for someone in audits, you can have things like theft. You can have things like there's what you guys call, I've forgotten, it's a risk management risk register that that audit people track in terms of risks, in terms of, okay, what are the potential risks that this business can face, can be exposed to, like, so you can then start to track those kind of risk for someone in audit. So you can set KPIs around them. Okay, for example, people who are in retail, you can set a KPI to make sure that you build a process whereby, or build processes whereby the missing items per store reduces from, maybe each store is having like 50 missing items every month. You can set a KPI to reduce that by 40. Now the operationalization of it is different, meaning that how you make it happen is a different conversation entirely. Like, okay, set controls, do whatever, internal audit and whatever. But there's a particular KPI set along that line to say, okay, hey, we are losing 50 items per store per month. We want to reduce that by at least 20%, meaning that our target is that missing items should not be more than 40. Then you can start to measure that based on whatever the parameters that you have set in place. So in simple terms, you don't need to be at the top to set KPIs. But the only tricky part is if you don't have certain skills and experience and understanding of business models, you will struggle to set KPIs. So setting KPIs involves a lot of conversation and a lot of soul searching, because you need to understand. Like I gave you a scenario of the last company I mentioned, whereby we were looking at expanding. We were competing with people that had money to open location in everywhere, whether it's profitable or not, but we didn't have the money. But we had to set up a KPI to do that. And I also gave you an example of someone who came to me and was telling me that, my balance sheet is looking bad because we have interest, yada, 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 so much loans on it. But because the person did not understand, I think the person just had about a year and a half work experience, funny enough. Very smart dude, no doubt. Very exceptionally smart guy. But he just didn't know what to ask. He just didn't know how to go about it, because it was something he read on the internet about some nice KPIs and all that. But from conversation with senior management or the manager, he got a more understanding of how to set KPIs and how to now be able to help the business. Because ultimately the goal is you're trying to help the business pull out stuff that would help make better and informed decisions. Now, KPI setting also, there's the organization wide, whereby senior management will say, okay, hey, this is our KPI, this is what we want to achieve, this is what we'll measure our performance by on a company level, on a department level, on an individual level. But you as a person, because you understand finance, you understand how numbers work, you're the one going for that to say, okay, hey, this type of information that I'm pulling, because the CEO will not have time to start pulling location of customers. Even your CFO won't have time for those nitty-gritty stuff. But you are the one who play around with data, preparing the report on a monthly basis. You have your hands in there. So you are the one who sees it. You are the one who will be able to now extract that information. Like, hey, this thing is tending towards a trend. What if I share this with my manager? So that's where the responsibility comes to say, okay, hey, boss, I just, in my own moments, I pulled out this information. I'm seeing this trend. Does this make any sense to you? Then you'll now be able to get a more detailed conversation. Oh, okay, wow, this is nice. Or, okay, no, this is what we're tilting towards. And this is how you can now help this situation. So to answer your question in simple English, there is no criteria saying as a junior person, you can't set up a KPI, and there's no rule saying that because you are in front desk, you can't set up a KPI. It's just pretty much about what you see that can help the business and have the conversation with the right person in the organization. I hope I answered your question.
Yes, thank you so much, sir. Thank you so
Sure.
much. Yes,
Thank you. Thank you very much, Mr. George. We have another question from Ogunleye Dare. Please, can you unmute your mic and ask your question?
Good evening. Thank you so much, sir.
Good evening.
My question is, what's the difference between key performance indicators and critical success factors?
Should I go academic or should I go practical? So if you look at it even from the words, it gives you an answer to it. So critical success factors means these are factors that are critical to your success, right? Like you must have these things for your organization to succeed, right? In simple English, I'll try and approach it from both angles. While key performance indicators are things indicating that you are doing well. Let me use Mr. Macaroni's famous line, you are doing well. So, academic-wise, one is saying that for you to do well, you need to have these elements in your business, these factors, okay? You need to have enough money, you need to have this, you need to have that, you need to have this, right? There are elements that must be in your business for you to succeed. You need to have customers buying, you need to have this. On the other side, the KPIs are okay, we've set a goal, this is what we want to achieve, right? These are our indicators that we're actually achieving it or not. These are the key things that we use to measure that, right? That's the academic side of things. But in real life, I can tell you for free, there's no difference. Nobody cares about those terminologies. Nobody cares. It's about how you embed both into what you are doing. So, for example, we have agreed that for us to succeed in a particular geographical area of the country, we need to have a presence in there. You know, my business is currently 90% of my customers are coming from Lagos, and I'm selling a product that can be used anywhere in the country, which is not the best for me. So critical success factors for me to be able to expand to other locations will be, I must have a presence in there. It could be that, okay, I need to have a physical presence in the sense that I rent my own office, put my own head count in there, put my people in there for them to be doing the work. Or I can decide to say, okay, let me outsource it, not to give myself the headache. What do? I partner with somebody who has a presence in there and use their facilities and pay them a certain fee every month. The critical success factor in there will be that I need to have a physical presence in that particular location. But in terms of KPI, the question now for my KPI will be, how would I now say I am successful? Do you get? How would I say I'm successful? Because if I am saying I'm successful, would I say, okay, yes, now that I put an office there, I should be able to now get, because maybe I'm getting only one customer from there or two before. With my office there, I'm expecting to now get 50 new customers. So my KPI in that scenario will now be to measure that, okay, am I getting 50 customers per month? If I'm not getting it done, where is the question? So in the first instance, I wouldn't even be able to measure a KPI if I did not fulfill my critical success factor, which is to put an office in that location. I mean, that's what we decide internally, say that, okay, that's the critical success factor, to have an office in there, or to have an employee who will sit down and monitor this. So they are interwoven. In academic terms, you can split it. Oh, okay, this is big English, this is big English, this is what it's saying. But in reality, when you are running a business, you don't really differentiate anything. You run both together. Okay, oh, I want to measure my growth in Benue State. Boom, I need to put an office in there. I've done that. Then I'm now measuring on a monthly basis. Okay, I've put in everything I need to do. Am I hitting the numbers? Am I achieving what I need to achieve? That's where my KPI starts to measure for what I'm trying to achieve. I don't know if I've answered your question. I'm trying to not ramble. I'm trying to break it down to a very simplified way for you to understand. So I don't know if I answered it.
Yes, thank you, sir.
Okay.
Thank you very much.
Yeah, go ahead.
Thank you very much, Mr. George. We have a question from Aisha.
Okay.
She's asking if KPIs are relevant to NGOs.
Absolutely. Absolutely. For every organization, there's a goal. There's a goal that was set up. So the question is, what is the reason the NGO was set up for? Is it to provide free education for 1,000 motherless children, or to provide employment for widows? Then you build your KPIs around that, because the question is, KPIs are goal at the top. This is what we want to achieve. Then how do we know if we're achieving those things? That's what KPIs do for you. Like, okay, what are the crucial things that we need to measure? A typical KPI, I was reading someone's very funny stuff I was reading yesterday about an organization that are saying that they want more women. What are we even saying? Okay, let me not use that one. It can be very sensitive. I wanted to use the Nigerian government saying that they will give 35% women participation in government. So a key KPI there, because that was one of the things that was given by the manifesto of the APC, right? So that's a key KPI. You can measure it. Are they achieving it or not? If they say, okay, I'm going to achieve X number of youths in there, the question is, are they achieving it or not? That's a KPI. The same thing with NGOs. If NGOs say, okay, I'm trying to think of one of the biggest NGO, United Nations. United Nations is actually an NGO. Even this SDG, so Sustainable Development Goals we're talking about, they set it, I think, some years back, that I think by, is it 2030 or so, I can't remember now, that they're going to achieve a certain number of Sustainable Development Goals, which one of it is what we are trying to drive, push in terms of affordable education for all. So the question is, are they achieving it? At least United Nations is a not-for-profit organization. It's an NGO. So the KPI we need to now check in there for them is, are they achieving their SDGs? They are talking of even climate change in terms of, making better environment, food for all. They have KPIs, and the KPIs are very easy to measure. At points, beginning of it, they had a number that, okay, there are, sake of argument, 100 million out of school children in the world. If we can implement this SDG for affordable education for all, we should be able to bring that 100 million to 1 million in 10 years. So the question is, if 3 years has passed, and question is, how many children have they been taken out away from that situation of being out of school to now being educated? So those are KPIs that you said, but for every single organization, any organization, even individuals, even you as you are, you have your own KPI. Some of you, your KPI of a KPI is to get married. Some of you, part of your KPI is to toast that girl before the end of next month. I must catch up. Whatever it is, some of you's KPI is I must go and find money to spend one night at Inagbe Resort or a Lekki Resort, whatever it is that you're trying to achieve as a goal. There must be an indicator that you are achieving that goal or not. And the importance of this conversation is to say, not every indicator it makes sense. There are some things that you would worry yourself to death, like someone who is earning 100K and spends 80,000 naira every month on transport, and he's saying he wants to save maybe whatever it is, you start to measure how much you spend on transport. When you see that you're already 90% on your transport, you now start trekking from Festac to Lekki. You want to save money, It might not be your best, but the bottom line is, what are the critical KPIs that you need to measure in that particular organization that can help you trigger achieving that goal faster? So I don't know if I answered that question for you.
Yes, you did. Yes, you did. Okay, so we have Yisia Ibrahim. I'm sorry, I don't know if I got the pronunciation. Ibrahim, please, can you go ahead with your question?
Yes, thank you very much. Yeah, thank you for this wonderful section. So I'm really so happy for joining. So I've actually learned a lot. Yeah, my question is this. KPI, I think, is about trying to forecast, like, okay, a target that, okay, maybe we need to define a target, then maybe through forecast or projection, then we know what to do. Now, let's assume, okay, we set a KPI for ourselves. Okay, let's say, okay, we want to acquire maybe a subsidiary or a company, then we set a KPI for ourselves. Then what is the effect of external economic factor? Let's say like things like that we cannot control. Like, for instance, a company just set a KPI, and then maybe next month, stuff like corona, pandemic, stuff like that just came in. Then the whole thing that they've set for themselves, that would be like jeopardized and not be realistic. So what's the effect of external market factors that cannot be controlled by the organization on KPIs? So that was my question, sir.
Okay, very good question. Very, very good question. And I think my very simplest answer to say is this. There's a flow to it. There's an objective and there are KPIs. What do KPIs do? KPIs help you track whether you're achieving your objective or not. And what are they? It's like, let me phrase it this way. You're leaving your house, you're driving a car, right? And there are 3 routes to take you to point B where you're trying to get to. As you leave your house, driving a car, you now say, okay, from your goal is that my assessment is that if I take point A, I will get there in 1 hour. Then you look at your Google map, you find yourself, okay, based on my KPIs, at least from point A has like 5 key milestones in between. By milestone 1, I should be there in 10 minutes. Milestone 2, I should be there in 15 minutes, yada, yada, yada. So you finish milestone 1, you finish milestone 2. You realize that, man, if I continue this way, my 1 hour journey will turn to 5 hours. As a business, what do? You need to call back, sit down, and reanalyze your goals and reanalyze your strategies towards achieving that goal. And that's what KPIs pretty much help you do. KPIs are key performance indicators. They are just telling you, are you getting towards what you are set to get or not? And the key essence of KPIs are this, because there are multiple levels in every organization. For you, as the one helping to track, ideally very junior staff is not your responsibility to set KPIs. But the whole idea of this is you can also help because you're part of the organization, and those are things that will help you climb faster. So first question there is, are you hitting the numbers that you want to hit? The answer is no. You can have the explanation, okay, maybe government changed the policy, yada, yada, yada. But at the end of the day, the essence of setting those KPIs or using those KPIs is for the owners of the business to be able to take a decision. So the next thing, what you're talking about now is about decision making. The owners of business now need to now ask, man, this thing we set as our target for this year, for example, a company who started 2023, for example, started with price of fuel at how much? 186. Started with price of diesel at, 600, 700. I can't remember exact amount now. Set a KPI to reduce costs by 20% or 30%. Set revenue to grow by X amount in January. February, no shakings. Suddenly, a new government came, removed subsidy. the factors change in the market, key elements, like you said, beyond your control, it is very clear that there is no way on God's earth, I'm sorry to say, if I'm not trying to blaspheme, that you will meet your cost reduction. Because if diesel has doubled in price, fuel has times 3 or times 4, and these are things that power your business, you are into production, there is no way you can reduce costs. And you also know, as an economist or finance professional, whatever it is, that the people's consumption power will also drop because there are more factors competing for their monthly income. It's the same fixed salary. At best, companies will probably add 10, 20% to you if you're lucky. But reality is your cost has gone up by double as a person. It will naturally cascade to the business. So the smartest thing for any business to do is to reevaluate all the KPIs that was set. It's called risk management. If you work with people in management positions, they'll tell you being a manager or CEO is all about daily risk management, understanding your goals, anticipating potential risks that may come, and managing those risks. So in this case, as a junior person in this organization, your job is to amplify the reality. Sir, this was our benchmark. This was our baseline. This is the reality that has moved. So ultimately, we are not achieving this. And from your analysis, this is where it is. You make the noise, like the Gabon president. I don't know whether you people saw it in Instagram when the guys did some video, tell them to make noise. So you make noise, like the man said, make the noise, escalate to management. And what typically will happen is they will recalibrate that KPI. Say, let's readjust our goal. Based on readjusting our goal, we reset our KPI. But ultimately, the goal there is for you to be able to analyze it, say, okay, hey, we want to reduce costs. We want to increase revenue. What are the key indices that we can use to measure if we're reducing costs? You've already known that, okay, part of things they're looking at is reducing diesel. So you can compare month on month. Oh, okay, diesel cost from last month dropped from volume dropped last month. So because part of your KPI is you can compare both volume and value. So in there, you can present the analogy that, yes, technically we are performing in terms of volume reduction. But where we're struggling is in value reduction because that is beyond our forces. So that way you will table your matter and your report, and the managers and the owners of the business will be able to now take a decision that, okay, look, on overall level, let's adjust some of these KPIs or let's do it this way. But ultimately, you've done your job because, like you said, you can't control what is beyond your control. You can't control what government is. But I can tell you from KPI setting, from organizational goal setting to KPIs at a senior level, risk management is always factored into it. Everybody plans. And that's why maybe you've heard it in your organization or not. Everybody's always talking about annual budgets. What is the country, apart from internal budgets, you're always trying to see what is the country's budgets are. Then everybody's always anticipating when new government is coming because you're trying to understand what government policies are. What is the thought process of the person who is going to be the president? Is it a person that would come and tax the hell out of everybody? Or is it somebody who will just do paddy government? Or is it somebody who will just be docile, who will just spend 8 years chewing, using toothpick every day? So those are things that government, senior management think about. Look at when they are taking their decisions and analyze that, okay, hey, this is the thought process of this person in government. For example, the current government, let me just digress a little. Everybody talks about, okay, when he was Lagos State governor, this is his policies and these are the thrusts. This is the direction he took things. And if you look at it, some of you may not know, or some of you may know, is trying to also bring in those guys he used then. I mean, with the exception of maybe Professor Yemi Osinbajo and a couple of other people, trying to bring in those guys and try to see if he can apply the same approach, to the Nigerian economic system. It's just that things are very, very tough, to be honest. It's more complicated than any of us can see from a distance. It's easy for us to look at the government and say they are not trying, but I can assure you, if you bring the best presidents into Nigeria today, they will struggle. There's no way around it, but that's a different conversation for a different day. So your job as a person is to look at the KPIs, identify them, report on them, and make all the noise to your manager or management. Say, hey, these are the things that the data is telling me from the KPIs that there's a possibility that we might not meet it because of A, B, C, D, and here. So I think it's something that you guys need to evaluate, and they will take the necessary action and decision with it. Hope I've answered your question.
Yeah, thank you very much, sir. Thank you. So really great too.
No problem. Cassava is a good government to Toyosi Abayomi, by the way. You don't know. There's what commoditization of the currency. It's not a bad idea. It's just that right now, the model we are in Nigeria, we are exporting raw materials, and there's no money in exporting raw materials. The money is in produced materials. That's where the money is. If you produce something, you can change the price. But if it's raw materials, you are competing with other countries exporting raw material. But if you can turn the Gary into something that other people in other countries want, we can actually increase the value of it and generate more revenue. But it's more complex, like I said. These things are not conversations you have in 5 minutes. They are deeper things. Security, so many things affecting it, perception. You know, do you even have the facility to store those things before it gets to be shipped abroad? It takes some months in the ship. Would it all be bad? So it's a long conversation for another day. So thank you. Any other question? Okay, Faith.
Yes, thank you very much, Mr. George. We have another question from Oluwashola Faith. Please, can you unmute your mic and ask your question?
Thank you very much, sir. And the question I want to ask is, can we use an organization SWOT analysis to measure the KPI and to set the KPI rather? And can you please give us the slide for the webinar for those of us that joined late? Thank you.
Okay. Good question. No problem. Definitely we'll share the slides. So in setting an organization objective, right, at least from every organization I've handled, SWOT analysis is one of the things you look at. You don't just set a goal that you want to go and you want to generate X revenue across the country when it's not part of your strengths and there's no opportunity there. So, for example, I cannot wake up and say I want to expand my business to Maiduguri, for sake, not to Borno State. You know, not because it's a bad place or anything, but if I don't have a strength in terms of understanding how people from that part of the country shop, what is their thought process, you know, like it will be hard for me to even set up a KPI. So, and I think, like I mentioned, the whole idea of KPI is you're already taking a KPI is taken from an objective. That's the first thing. There has to be something that you have set out to achieve. So, and before you can have an objective, you must have done your risk management or SWOT analysis. You don't just wake up that we're going to grow revenue by 100% in 2024. You and I know that it's impossible with the way the country is. Right now, the country is still trying to find a footing to get out of whatever it found itself. So we all know that. Okay, so let me answer that question with a different perspective. I was having a sort of analytical conversation with somebody else some few weeks back, using Nigeria as an example. Nigeria is the bride of international investors. Why? Because there's an estimated population in Africa of 1 billion people, and Nigeria is about 20% of the total population of Africa, which is why they call it the most populous black nation. Meaning that Nigeria has about 200 million in population. So I'm trying to give you a quick analysis here. If Nigeria has 200 million population, to any investor, it's the darling of anybody that wants to put money in an economy. And I'll tell you why. A comparison, you might say this is wide off, you might say it's close, is the United States of America. United States of America has about 300 million in population. It's estimated that about 66 to 70% of Americans are middle class. Middle class people are people who earn $50,000 to $60,000 a year in salary, meaning that they are comfortable. They can buy a house, they can buy a car, they can afford basic things of life without complaining. 66%, that's about 200 million. So an investor knows that if I put any business in the US, I don't need to have 200 million people buying. I just need 1 million people, 2 million people buying my product, and I'm doing good. So, for example, if I'm selling a product for $5 and 1 million people are buying, that's $5 million every month. I'm very all right. In Africa, there are two big economies. You have even Egypt and Co also coming, but everybody always looks at Nigeria and South Africa. South Africa is just about 60 million in population. By the time you discount that further, you see that their middle class is just about 50% of that. Yeah, so in reality, there are about 30 million potential market customers. By the time you break it down further, you'll see some numbers in there that, okay, maybe if I bring a product there, I have 1 million, 2 million people buying from South Africa. Nigeria, on the flip side, before Nigerian Bureau of Statistics brought out its very destroying data, but they don't know. Nigeria has 200 million. So if I'm a businessman, I'm thinking the average country with such a huge population will have a middle class of about 50-60%. So if 50-60% of middle class in Nigeria were ideally middle, or 50-60% of Nigerian population is middle class, so I should be having 100 to 120 million people. That's a potential customer. So I know that it won't be a difficult thing for me to get 1 million people to buy, right? Guess what? Nigerian Bureau of Statistics came up with data to say 133 million Nigerians are living in multidimensional poverty. The word poverty alone is a red flag for an investor. That's one. Then two, you now put the word multidimensional, which makes it for me like, what are you talking about? Is the reality whether we like it or not? So now an investor will come and say, okay, hey, the real population in Nigeria from the perspective of an investor is 70 million. If you tell me that 133 million of your people are poor, extremely poor in different dimensions, I'm going to say, okay, so the real people in Nigeria that are people can spend stuff is 60 to 70 million. Then I'm not going to now discount that 60 to 70 million to say, okay, because in investment, there's what you call TAM, total addressable market. There's what you call SAM, serviceable addressable market, and SOM, serviceable obtainable market, meaning that the total people in the markets that actually has the money that can buy your products versus the total people that will be willing to buy your product. Yes, people have the money, but it's not everybody that will buy from you. Then even the one that will want to buy from me, it's not all of them that will still eventually buy from me. So as an investor, if I'm breaking those things down, a normal investment logic for a term, if the average people use is 10% of the people that can buy from you. So in this scenario, 70 million, right, is what we said people that are at least middle class are not poor. So if I have 70 million, only 10% of that are people that I can really get, which is 7 million, right? And from 7 million people, as a business, your sum, which comes to about 6% of your sum, means that I'm going to have a market of just 6% of that 7 million people, which is like 400,000 or 300,000 customers, potential customers that can buy from me. So as a business person, right, coming into such a market, if I'm going to set my KPIs, I'm not going to be setting my KPIs on or objective on selling to 200 million Nigerians, whatever I'm selling. I'm going to be setting it on selling to just about 400,000 Nigerians because that's the reality. That's the real market. So in essence, what I'm trying to say is for senior management, they would have done all those risk analysis, analyzed it and looked at what is the real market, from there, if I'm setting my KPI against next year, and because I understand that currently the country is going through whatever it's going through and there's still instability in terms of policies right now. I can easily tell you that from next year, I'm not going to expect growth in my sales. Because when you implement a very huge two huge policies like we've done, or three, the dollar, the fuel subsidy removal, people will still be in shock for the next 6 months to 1 year. Because right now, a lot of people are trying to adjust. There's now more things. You have a number of things competing with your monthly income before your salary. But now, some other things are taking a higher chunk of it. Your transportation is going to take a higher chunk. Your cost of living, for some of you paying rent, your rent will go up. So all those luxuries are going down. I think you that every Friday you used to hang out, you probably break it down to one Friday a month. Or even just buy your one bottle, drink it in your house. Whatever it is. So as the businessman, I understand that now, if my product is not a necessity, that you need it absolutely like food, me projecting that next year I'm going to grow, I'll be lying to myself. So in that scenario, they will now determine what the goals are for the company. That, okay, we won't be able to grow by 120%. We'll probably drop in revenue, or let's stabilize. Let's retain the existing revenue you are making. So that way, your KPIs will now determine that. So in terms of that, those are things that you now build a KPI around that. Okay, maybe before you are saying, just ordinary customers. My KPI before is average customer buys 4 times a month, 5 times a month. So your new KPI can now be measuring at least my customers will buy once a month. So any customer that I see that are not buying once a month, I can trigger that conversation with the marketing team that, hey guys, this person hasn't bought for 2 months, and historically this person buys every single month. Is there any campaign that we can use to reactivate it? So with that, my analogy, I hope I'm able to explain it to you. KPIs come from organizational goals or individual goals. It's just to measure that, are we hitting that goal or not? So if your goal is faulty or is not realistic, your KPIs will never be realistic. So whatever you need to set, you always need to set it along the line of that goal you are trying to achieve. I hope I answered your question.
Yes, sir. Thank you, sir.
Okay.
Thank you very much, Mr. George. We have one more question from the chat box. Samson is asking if there are job roles for which KPIs are not applicable. He said, to put in other words, can all job roles be quantified in terms of performance and thereby measured?
Absolutely. For every job role you have, the first thing they'll give you is a job description. That's where you determine your KPI from. Like, they won't just say, come and start work without telling you what you do. So is the ability to do what you've been given a contract to do that will determine how your performance is measured. Even security guards standing in where you buy fast food or whatever, there's an employment letter. Your job is to make sure that no crime, no whatever. You set a KPI monthly. How many crime or how many exceptions do they have? Is there anything that is showing like a negative trend that needs to be dealt with? So every job, anything in life can be measured. Even you that you want to toast babe, it can be measured. In your head, you can, know whether you are achieving the goal or not. The goal is to get the babe. You know that you've read plenty people say you must talk to her 50 times. You've only spoken 20 times, already given up. You must measure it that, okay, come. Be like saying at Christmas, this girl go agree. So you start to track, okay, I must talk to her twice every month before Christmas. So anything in life can actually be measured. You can set a KPI for everything. Yeah.
Thank you very much, Mr. George, for that amazing, for all the amazing answers you provided to the questions. I learned a lot, and I'm sure every other person here also learned a lot. Do we still have any question for Mr. George? So I think there are no more questions. And okay, also someone asked for the slides. Yes, the slides will be provided on WhatsApp. So if you are not yet a member or you are not in our WhatsApp community, kindly check the chat box. The link to all our social media platforms are there. We have an active presence on both LinkedIn, Facebook, Instagram, and WhatsApp. So it will be a very good opportunity for you to join. And also the link to Mr. George LinkedIn is also there. You can connect with him and ask him more questions. He would answer you. So with that, we have come to the end of the September edition of the Meet and Chat with the Professionals. As I said earlier, this is a monthly session held or hosted by the Finance Business Partners. So we look forward to seeing each and every one of you at the October edition of the Meet and Chat to the Professionals. And this is me telling you happy new month in advance. So okay.
Yes.
So as we round up, if your hands are not too busy or if you are free, can you unmute your mic and just say thank you to Mr. George?
Mr. George, thank you very much. Really
Thank you,
appreciate it.
Mr. George.
Thank you very much, sir.
Thank you guys, and happy Independence Day.
Same to you.
Sir.
So thank you very much, everyone. See you next month. Bye-bye.
Yeah. Bye guys.
Bye. Bye-bye.